studying your last two. I swim med when turned in. The staring down to mute. And can learn the pole that sunk he died.
Now that we understand what the small business deduction is and who can claim it, let's see how it actually works during the corporate tax calculation. The process begins when a corporation earns active business income. Before any deduction is applied, the corporation calculates its federal corporate income tax based on its taxable income. At this stage, the tax is calculated using the normal corporate tax rules. Next comes the small business deduction. This deduction is built directly into the federal tax calculation. It reduces the amount of federal corporate tax that the corporation has to pay on its qualifying active business income. Notice that the deduction reduces the tax itself. It does not reduce the corporation's business income, and it is not a separate payment, rebate, or refund from the government, because the corporation pays less federal tax. More of its profits remain inside the business after taxes have been paid. These retained earnings can then be used to reinvest in the business, purchase equipment, hire employees, expand operations, or strengthen the company's financial position. If we compare two identical corporations earning the same amount of business income, the corporation that qualifies for the small business deduction will generally pay less federal corporate tax. As a result, it keeps more after-tax cash than a corporation that does not qualify for the deduction. This is why the small business deduction is considered one of the most valuable tax incentives available to Canadian-controlled private corporations. It allows eligible businesses to retain more of their earnings and reinvest those profits to support future growth. The key point to remember is this: the small business deduction is built into the federal corporate tax calculation. It reduces the amount of federal corporate income tax payable, allowing eligible corporations to keep more of their profits after tax. Now that we've seen how the small business deduction reduces corporate tax, let's look at where this deduction actually appears on the T2 corporate income tax return. The T2 return follows a logical sequence. It begins by calculating the corporation's taxable income. Using that taxable income, the return then calculates the corporation's federal income tax before any special deductions are applied. Once the initial federal tax has been calculated, the small business deduction is applied within the tax calculation itself. This is an important point to understand. The deduction is not claimed as a separate application, and it is not added after the return is completed. Instead, it forms part of the federal tax calculation on the T2 return and directly reduces the amount of federal corporate tax payable. After the small business deduction has reduced the federal tax, the return continues through the remaining tax calculations to determine the corporation's final tax payable. That final amount is what the corporation pays to the Canada Revenue Agency. As a tax preparer, it is helpful to think of the T2 return as a series of steps. First, calculate the corporation's income. Next, calculate the federal corporate tax. Then apply the small business deduction if the corporation qualifies. Finally, determine the reduced corporate tax payable. This approach makes it much easier to understand how the T2 return is organized and why the small business deduction is considered part of the tax calculation rather than a separate benefit. The key takeaway is this: the T2 return first calculates federal corporate tax, then applies the small business deduction to reduce that tax, and finally arrives at the corporation's tax payable. The deduction is built directly into the tax calculation, making it an integral part of the T2 return. Let's put everything together with a simple example to see how the small business deduction affects a corporation's tax calculation. Imagine a Canadian-controlled private corporation earns $100,000 of qualifying active business income during the year. This income is first used to calculate the corporation's federal income tax under the normal corporate tax rules. At this stage, the tax is calculated before applying any special deductions. Once that initial federal tax has been determined, the small business deduction is applied. Instead of reducing the corporation's income, it reduces the amount of federal corporate tax payable on that income. As a result, the corporation pays less federal tax and retains more after-tax earnings inside the business. Those retained earnings can then be used to purchase equipment, hire employees, expand operations, improve cash flow, or invest in future opportunities. Now compare this with another corporation that earns the same amount of business income, but does not qualify for the small business deduction. Because it pays a higher rate of federal corporate tax, it keeps less money after tax. Although both businesses earn the same income, the qualifying corporation finishes the year with more cash available for reinvestment and future growth. This example demonstrates an important principle of Canadian corporate taxation. The small business deduction does not create additional income, and it does not provide the corporation with a government grant or refund. Instead, it reduces the amount of federal corporate income tax that an eligible corporation must pay. As you prepare corporate tax returns, you can think of the calculation as a simple sequence. First, determine the corporation's active business income. Next, calculate the federal corporate tax. Then apply the small business deduction if the corporation qualifies. Finally, arrive at the reduced corporate tax payable. The key takeaway is this: the small business deduction is built directly into the T2 corporate tax calculation. By reducing the federal corporate tax payable, it allows eligible Canadian-controlled private corporations to retain more earnings and reinvest those profits to grow their business.